Welcome to the Opening Bell Report.
Okay, so I'm looking at the data on SoundHound AI today, and my head is kind of spinning. It's a wild disconnect.
It's a very strange picture, isn't it?
Yeah. We're looking at this analysis report, and it paints a picture of a company that is just, absolutely exploding. The revenue numbers are the kind that, most CEOs would kill for.
Mm-hmm.
And yet you pull up the stock chart for the day this report was looking at, and it's just a sea of red. It's down about 5%.
It creates a really conflicting narrative. On one hand, you have the market sentiment, which seems to be, sell, sell, sell.
Right.
But then the fundamental data in this report is just screaming growth.
Exactly. It's like walking past a restaurant with a line out the door. People are practically fighting to get a table. The kitchen is on fire in like the best possible way.
Yeah.
But there's a sign in the window that says, going out of business. It doesn't add up. So our mission for this deep dive has to be bridging that gap. We've got to figure out why a company posting 73% revenue growth is seeing its stock take a nosedive. Is the market missing something huge here?
Well, that's really the core thesis of the analysis we're breaking down. The report argues there's this massive disconnect between what they call the amateur view, which is totally fixated on the daily stock swings and profitability.
The day-to-day noise.
Exactly, the noise. And then there's the pro view, which is looking purely at the acceleration of revenue. They're making a case that SoundHound, ticker SOU, isn't just another company riding the AI hype train. They're saying it has entered legitimate hypergrowth territory.
Okay, hypergrowth is one of those buzzwords that gets thrown around a lot in tech.
Mm-hmm.
Sometimes it's used to mask a ton of problems.
For sure.
But you mentioned the number, 73% year-over-year revenue growth. I really want to put that into context because percentages can be misleading in a vacuum.
Yeah.
If I sell one lemonade and then the next day I sell two, that's 100% growth, but I'm not a billionaire.
Right. Good point. But we're not talking about lemonade stands here. To put 73% in perspective, just look at the broader software sector. A healthy company, a Wall Street darling, is usually thrilled to hit the rule of 40.
Where growth plus profit margin equals 40.
Yep. And SoundHound is almost doubling the growth part of that equation alone. Most mature tech companies fight tooth and nail just to get to 20%. So when this report flags this as hypergrowth, they're using that term mathematically, not just as marketing fluff.
So they're growing 3.5 times faster than their peers.
That's the key stat. The velocity is just off the charts.
Okay, velocity is there.
Yeah.
But I'm always skeptical of where that growth is actually coming from. Is this, just theoretical revenue? Is it all backed by pilot programs that could just vanish next quarter? We've seen a lot of AI companies with these huge projected pipelines that never turn into real cash.
And that is the critical distinction this report tries to make. They really emphasize that this 73%, it isn't based on maybe money. It's being driven by concrete, cumulative subscriptions and signed contracts. They specifically point out that SoundHound has moved beyond just R&D and is now actively embedding its AI into the physical world.
Voice AI for things. That's the phrase they keep using.
Yes, and I think that phrase is doing a lot of heavy lifting here. When most people think AI right now, they're thinking of large language models. ChatGPT, Claude, typing into a box on a computer screen.
Text AI.
That's text AI. SoundHound is betting the entire farm on voice AI, but not just for your phone. They're putting it into cars, into drive thrusts, into smart devices.
Let's drill down into the car thing first, because the report mentions some serious heavy hitters. Hyundai, Stellantis.
Mm-hmm.
And Stellantis owns Jeep, Dodge, Chrysler. These aren't small-time players. But here's my question. Voice assistants in cars have been, frankly, terrible for the last decade.
Yeah, well...
You press a button, you say, call mom, and it changes the radio to AM static.
Yeah.
So why is SoundHound winning these contracts now? What's changed?
That frustration you're describing is actually SoundHound's biggest selling point. The report highlights that legacy voice systems were so rigid, they needed specific commands.
You had to speak its language.
Exactly. SoundHound's specialized voice AI is designed to handle natural language processing specifically for the automotive environment. It's all about context. If you say, I'm cold, to an old system, it might, search the web for the definition of cold.
Right.
SoundHound's integration is designed to actually turn up the heat.
So it's the difference between a search engine and a smart assistant that can actually control the hardware.
Precisely. And for a company like Hyundai or Stellantis, this isn't just a cool feature anymore, it's becoming a safety requirement. They want drivers keeping their eyes on the road, not fumbling through menus on a touchscreen to find a charging station or change a playlist. The report suggests that SoundHound's ability to bridge that gap-complex conversational AI inside a noisy car is why their backlog of orders is growing so fast.
Okay, so the automotive use case makes sense. It's safety, it's convenience. But then the report pivots to a completely different sector, fast food. White Castle, Jersey Mike's. I have to admit, seeing a high-tech AI company list White Castle as a key partner is a little amusing.
It does sound funny until you look at the economics of a drive-through. The report notes that these quick service restaurants are facing a massive labor crunch. It is incredibly hard to find people willing to wear a headset for 8 hours, trying to figure out static-filled orders and dealing with customers, all for minimum wage.
And just trying to get the order right. I think we've all had the experience of shouting at a drive-through speaker only to end up with the wrong burger.
Right. So SoundHound comes in with an automated voice ordering system. It doesn't get tired. It doesn't misunderstand accents as easily as older tech. And it can upsell every single time without feeling awkward. Would you like fries with that? Happens 100% of the time. The report argues this 73% revenue explosion is being partly fueled by these big restaurant chains, realizing that AI isn't a gimmick. It's an operational necessity to keep the line moving and increase the average order size.
So we're solving a boring, expensive problem labor efficiency with some really cutting-edge tech. I get that. But I want to pivot us back to the financials, because this is where I get hung up.
Yeah, let's talk about it.
We've established the growth is real, the products are working, but the report brings up a critic's view we can't ignore. The stock is expensive, like really expensive.
It is. The valuation is definitely the elephant in the room.
There's set a price-to-sales ratio, the PS ratio of 29. For anyone listening who tracks these metrics, you know the average for software can be anywhere from, 8 to 12? 29 just seems stratospheric.
It's way up there.
It feels like buying a house for triple the asking price because you think the neighborhood might get cool in 5 years.
That's a valid concern, and it's why the stock has so many people betting against it. A 29x multiple means investors are paying $29 for every single dollar of revenue the company makes today. That is a massive premium.
Huge.
However, the analysis report offers a counter-argument to this overvalued narrative. They do a direct comparison between SoundHound and C3.ai.
C3 is the other big pure-play AI stock that people usually talk about.
Correct. Now, C3.ai trades at roughly 6 times sales.
So on paper, C3 is the bargain. It's way, way cheaper.
If you're shopping purely on that price tag, yes. But the report argues you have to look at what you're actually buying. C3.ai is growing its revenue at about 21%. SoundHound is growing at 73%.
So we're right back to the speed argument.
Exactly. The report uses this analogy that I think really clarifies the mindset here. It says you pay more for a Ferrari than a Toyota because it goes faster. If your goal is to get to a specific destination, in this case massive future scale, as quickly as possible, you pay the premium for the faster engine. They argue SoundHound's 29x multiple is justified because it is the Ferrari of voice AI.
I hear the Ferrari analogy, but I'm not sure I fully buy it. A Ferrari is a luxury good. A stock is a financial asset. If I pay 29 times sales for a company that's burning through cash, isn't that less buying a fast car and more gambling on a prototype?
That's a fair point.
If that growth slows down even a little bit, say it drops from 73% to 50%, that multiple gets absolutely crushed, doesn't it?
You are absolutely right to be skeptical. That's the inherent risk of a growth at all costs valuation. If the growth decelerates, that premium just evaporates. However, the report's bullish case is based on the idea that the growth is actually accelerating, not decelerating. They believe the backlog of contracts, those deals with Stellantis and the restaurants, that locks in future revenue that the market isn't fully appreciating yet. They see the 29x not as a permanent state, but as like a forward payment on revenue that's going to double and triple in the next few years.
Okay, let's assume the growth continues. Why SoundHound? And I ask this because whenever we talk about tech, there's always the giant shadow of big tech. Why doesn't Hyundai just use Google Assistant? Why doesn't White Castle just use Amazon's Alexa? These companies have infinite resources. How does a smaller player like SoundHound build any kind of defensive moat?
This is, in my opinion, the most fascinating part of the entire analysis. The report explicitly identifies SoundHound's moat as its independence. It sounds counterintuitive, usually being smaller is a weakness. But in this specific market, being neutral is a superpower.
Explain that. Why does being neutral matter to a car company?
Think about it from the perspective of brand identity and data sovereignty. If you're the CEO of Mercedes or Hyundai, that dashboard is the most valuable real estate you have. It's your direct link to your customer.
It's how you interact with them.
It is. So if you install Google Assistant or Apple Siri as the native interface, you are essentially just handing the keys to your customer relationship over to a third party.
You become just a hardware shell for Google software.
Exactly. You become a dumb pipe for someone else's ecosystem. And even worse, what happens to the data? If a driver asks their car to navigate somewhere or buy something, who owns that intent data? If you use Amazon's tech, Amazon gets that data.
And Amazon might use that data to sell things to my customer, completely bypassing me.
Correct. The report posits that SoundHound is the independent alternative. They offer the cutting-edge voice AI, the brain, but they let the car manufacturer or the restaurant brand keep their own identity and, crucially, their own customer data. SoundHound is like Intel inside. They power the experience, but they don't hijack the relationship.
That is a really strong strategic argument. It's basically about data sovereignty. Big brands are terrified of being eaten by big tech, so they're willing to pay a premium to SoundHound for protection.
That's the moat. And the report suggests this is exactly why SoundHound is winning these massive enterprise contracts, even when Google and Amazon might be offering cheaper or even free alternatives. The independence is the product.
Okay, so we've got the hypergrowth engine, we've got the independent moat strategy, and we have the Ferrari valuation. The report mentions some analyst projections. What kind of upside are they seeing here?
Well, based on their analysis of the charts and the fundamentals, the report cites a price target of $16.30.
And just for context for the listener, where was it trading around the time of this report?
Around $10 a share, so that represents a roughly 58% upside from those levels.
That's pretty significant.
It is. And looking further out, they see a clear path toward $200 million in revenue. If they hit that milestone, the argument is that the company basically validates its massive valuation and transitions from a speculative play into a real market leader.
Okay, I'm feeling the bullish case. I can see why people are so excited, but I have to pull us back to reality for a minute. We started this whole deep dive talking about a red day on the market. We have to look at the risk meter on this report. What could go wrong?
Yes.
Because when you're driving a Ferrari at 200 miles per hour, if you hit a pothole, you don't just get a flat tire. You disintegrate.
You certainly do. And the report does not shy away from the risks at all. The biggest red flag flashing on the dashboard is the cash burn. The report highlights a profit margin of negative 63%.
Negative 63%. Let's be really clear what that means. For every dollar of revenue they bring in, they're spending a dollar. And then another 63 cents on top of that.
Essentially, yes. They're spending a ton on R&D to maintain that tech advantage, and they're spending heavily on sales and marketing to get those big contracts. This is, pretty typical for a hyper-growth phase, but it makes the company incredibly fragile. They have to keep raising money or growing revenue fast enough to outrun their expenses.
It's the classic burning the furniture to heat the house scenario. You're just hoping you can build a mansion before you run out of chairs.
And that fragility leads directly to the second major risk the report highlights: extreme volatility. They explicitly warn investors to expect 5 to 10% swings daily.
Daily? That's not investing. That's signing up for a prescription for blood pressure medication.
It is a total battleground stock. You have the believers who see the next Amazon on one side, and you have the short sellers who see an overvalued cash-burning company on the other. That tug of war creates massive turbulence. The report uses a metaphor. This isn't a savings account, it's a rocket ship. Rockets shake.
I like that metaphor. But rockets also have a tendency to explode on the launch pad. We've seen plenty of rocket ship stocks in the last 5 years that never made it to orbit.
That's the gamble. The report is very, very clear on this. This is a high-risk, high-reward proposition. If that growth slows, or if the moat of independence gets breached by a better open-source model, the downside is incredibly steep.
So let's try to synthesize all this.
Yeah.
We have a company that is undeniably exploding on the top line. 73% is a number you just can't ignore.
You can't.
They've validated their tech with major global brands in cars and food. They have a strategic narrative about independence that makes a ton of sense in a world that's terrified of big tech monopolies.
Yeah.
But they are bleeding cash.
Yeah.
And the valuation requires perfect execution for years to come.
That is the perfect summary. It all comes down to your conviction in the macro trend.
And what does the report say is the ultimate macro trend? If I'm sitting on the fence, what's the one belief I need to have to even consider this stock?
The report concludes with a conditional statement that I think frames it perfectly. It says, if you believe voice is the next interface after touch, SoundHound is the trade.
Voice is the next touch. Let's just unpack that for a second.
Think about the last major interface shift. We went from physical keyboards, Blackberries, to multi-touch glass screens with the iPhone. That shift completely destroyed the incumbents who didn't adapt, and it created trillion-dollar empires for those who did.
Right.
The report argues we are on the precipice of the next shift. As AI gets smarter, we shouldn't need to be tapping on glass to get what we want. We should just be able to speak.
It's true. When you think about it, typing is actually a really inefficient way for humans to communicate. It's slow. Speaking is fast.
Exactly. And up until now, the technology just wasn't good enough to handle all the nuance of speech. But SoundHound's 73% growth suggests that maybe we've crossed a threshold where voice is finally becoming viable for complex tasks. If the future of computing is conversational, if we really are going to talk to our cars, our homes, our devices like we talk to another person, then SoundHound is positioning itself to be the operating system for that future.
That's a heavy thought to end on. It's not just about whether SoundHound makes its quarterly numbers. It's a bet on a fundamental shift in human behavior. Are we ready to stop poking at our phones and start having a real conversation with them?
And are we ready for the world where those devices talk back? It changes the relationship fundamentally. We're not just users anymore. We're conversational partners.
Well, whether you think SoundHound is the key to that future or just a very shaky rocket ride, the numbers are definitely demanding our attention. It's rare to see this kind of growth without some serious story behind it.
Absolutely. The data tells a compelling story, but as always, the market is going to decide the ending.
Thanks for diving in with us. We'll be keeping an eye on the charts, red or green, and we'll catch you on the next one.
Take care.
Don't forget to like, share, and subscribe for more.